2022 marks the year of the tiger being known for its competence and courage in the face of challenge. We saw the epitome of courage as the Ukrainian people stood to defend their country against the Russian invading force late last month. The Ukraine-Russia crisis has captured the attention of the globe and sent ripples through global markets. Global markets have been afflicted by multiple troubles: fears of rising interest rates, soaring inflation, and continuing supply chain bottlenecks. The Russian hostilities in Ukraine will increase uncertainty further. After 2 years in a global pandemic, market participants have been hoping that the theme for 2022 is normalization, and hopefully the beginning of the end of the pandemic. The current conflict has the potential to add further complexity for policymakers as they plot their way towards normalization after the pandemic. There are many shifts and themes that have been shaping markets post the 2020 pandemic. Today, I will talk to you on how some of these broader themes are touching the various alternative investment strategies and our portfolios. One of the mega trends that one has to marvel at is the acceleration of ESG and sustainable investing practices. We know markets have a transformative effect on society and can build a better world, and investor focus on sustainability has never been greater. To that end, the United Nations has set 17 Sustainable Development Goals, which provide a powerful aspiration for improving our world. These have been addressed in many a forum, and I will not be discussing these in detail today. The 17 goals are integrated, and action in one area will affect outcomes in others. As a reminder, these are the goals that Momentum Investments have chosen to focus on. Alternative investment strategies have the unique ability to drive purpose-driven investing through their ability to target investments and to drive policies across portfolio companies and direct strategies. Momentum Investments' Impact Fund range aims to achieve large-scale impact at appropriate long-term investment returns. The range offers an alternative energy portfolio, which invests across a range of clean energy projects offering attractive returns. A social infrastructure portfolio, which invests in projects that are addressing some of the social infrastructure gaps, such as student accommodation and affordable housing, and a diversified infrastructure portfolio, which invests across a range of mature and growth assets to address a range of infrastructure needs while simultaneously offering good returns. Across the portfolios, we are working on our pipeline of executable deals. Our existing mix of mature and growth assets have delivered good returns over the period, emphasizing the robustness of the projects in a still difficult operating environment. There has been an increase in activity, particularly in our alternative energy fund, with a number of transactions currently being worked on. The continuing shortage of energy in the country means that this will be a significant area for the fund to deploy its capital for a protracted period of time. While the Department of Mineral Resources and Energy announced preferred bidders at the end of October for the latest round of the REAP program, it will take another 2 to 3 years for those projects to start generating power. The Risk Mitigation IPP program is mired in court action, which will further exacerbate the shortfall. The increase in the cap for self-generation of electricity should see increased private power purchase agreements being entered into. We are already seeing an increase in opportunities as a direct result. Much work is being done by investors to get comfortable with the creditworthiness of these off-takers. Similarly, with all the country's major metropolitan municipalities also looking to purchase power from independent producers, it's clear that there will be a significant capital to be invested in this area. Sufficient, affordable, and reliable supply of electricity is desperately needed to get the local economy operating at a higher growth rate. In our social infrastructure portfolio, we have added additional capital to our student accommodation investment. This is to fund new student accommodation projects in Johannesburg and Cape Town. Affordable, well-situated student accommodation is still in short supply, and through our investment in this area, we aim to help alleviate this. Our diversified infrastructure fund has seen a steady improvement in the mature toll road investments. Road traffic over the December period had increased from the previous year and was around 10% ahead of budget. The fund's newest investment in CIVH has also performed strongly as it continues with its fiber rollout. The company announced a transaction with Vodacom, which would see a merger of their fiber infrastructure assets. This will add considerable long-term value to the business, and the valuation of the investment consequently increased by 8%. Another mega theme playing out across the markets post the pandemic is that of technological adoption. In the 2022 JP Morgan Global Investment Outlook, global investors cited technological innovation as among the most potent forces generating venture capital, growth equity, and buyout opportunities. Not only among traditional tech companies, but across almost every sector of the economy, driving an expanding opportunity set for the strategy. We have seen this theme across our private equity portfolios. As a reminder, our private equity program follows a hybrid model and invests both in private equity as well as in direct co-investments. This slide illustrates a few of the tech-focused opportunities that we currently have exposure to, either through our direct investments or through investments in our portfolio companies. This chart shows the year-on-year performance to the end of December 2021 for the Private Equity Fund 3. I have highlighted the performance of some of those larger fintech and digital infrastructure exposures in the portfolio, and one can see the clear uplift that we have seen from this theme. The direct co-investment portfolio continued to contribute to the increase in valuation, with exposures to Vox and Channel VAS significant contributors, and still expected to add continued value over the coming years as this theme plays out. This chart also illustrates that portion of the book that has delivered muted performance. Private equity investments are not immune to macro factors and valuations, and deal activity also contracted sharply in the immediate aftermath of the onset of the pandemic. As the local economy continues to normalize, we expect further value uplift from the remainder of the book. Market participants were divided through much of 2021 around the global inflation trajectory, and it became clear towards the latter part of the year that inflation was not as transitory as many investors and policymakers had assumed. There are significant questions around the likely trajectory of monetary policy in 2022, and more so following Russia's invasion of Ukraine, the upheaval likely to be felt differently across the world's major economic centers. Any rise in business failures as a result of monetary policy tightening would put increased pressure on banks' balance sheets and their ability to lend. Small and medium-sized enterprises could be especially vulnerable to any dip in the availability of bank credit. This creates an opportunity for private credit funds to fill the breach by helping to finance businesses that have strong growth potential but little access to mainstream funding. Momentum Investments Special Opportunity Fund aims to exploit high-yielding investment opportunities across the capital structure, investing across unlisted debt, unlisted equity, and hybrid instruments. The corporate debt strategy focuses on direct lending opportunities to unlisted SMEs, with loans typically underpinned by a single material asset or portfolio of assets and guarantees from the sponsors. We continue to see new opportunities and a strong pipeline, reaffirming the quality of the network. The SARB hiked interest rates by 25 basis points in the fourth quarter. Given the majority of the portfolio's debt instruments are floating rate instruments, the yield on this part of the portfolio will increase with upward adjustments to the repo rate, and the portfolio will naturally benefit from further rate increases. The property development strategy has exposure to high-yielding, unique property opportunities. These positions are in varying stages of value creation and realization. Most noticeable over the fourth quarter of last year was the realization of the flagship investment within the corporate recovery strategy. This investment yielded an exceptional IRR of 18% and the saving of over 1,500 jobs, also contributing to achieving SDG 8 to support job creation and growing the economy. An excellent result for the fund, the investors, and the economy. Work continues to uncover specialist investment strategies that meet the portfolio's return objective. This fund has returned a noteworthy CPI plus 5.5, net of all fees since its inception. The alternative investment strategies that I've discussed so far have been those looking to extract an illiquidity premium from private market investments. The more liquid of the alternative investment offerings is the hedge funds, which invests across more liquid instruments and is looking to extract a volatility premium. Which brings us to the last theme for today's presentation. Global markets witnessed an increase in volatility in the latter part of last year, responding to global inflation concerns and the emergence of the Omicron COVID strain. This volatility continued into this year, with inflation, growth, and the Russia-Ukraine conflict dominating market moves. This chart shows the movement of the VIX. The VIX is used as a barometer of risk, fear, and stress in the market, with levels above 30 indicating tremendous uncertainty. The change in the level of the VIX infers the expected daily market moves. One can see in this chart that the VIX at recent levels is indicative of higher daily ranges. This chart is updated to the end of February, and also interesting to note is the increase in the VIX with the invasion of Ukraine at the end of the month. Generally, unsettled market conditions lead to higher levels of dispersion in markets, which is typically what hedge fund managers need to extract alpha. However, trading an event risk isn't easy at the best of times, and the events in Ukraine and the uncertainty to follow requires that fund managers focus on capital preservation and staying nimble. Across our equity strategies, we have a meaningfully long position in gold counters as a broad hedge, as well as a long resource position, which has steadied the portfolios well. With the increase in risk already seen late last year, there has been an increase in hedging through derivative structures and short positioning, and a shift to more defensive positioning across the equity portfolios. We continue to hold our volatility-sensitive strategies for further diversification going forward. This positioning contributed positively to the overall performance for the quarter and the calendar year. Fixed income arbitrage also contributed positively for the period. The investment managers in this complex correctly anticipated the SARB's decision to increase rates in November. The portfolios are positioned for a shallower hiking cycle than the market is currently pricing. Potential vulnerabilities to the rand and the anticipation of a now more structural inflation trajectory are bound to create greater volatility, but also more opportunity, as these investment managers are able to take short positions in anticipation of any weakness. Looking forward, we expect the global news flow to continue to dominate local market sentiment. As I mentioned earlier, the theme for 2022 has been touted to be that of normalization. The current conflict has the potential to add further complexity for policymakers as they move towards normalization post the pandemic. In this environment of heightened uncertainty and increased event risk, diversification across portfolios is key. Given the current low or negative real yields and inflationary pressures, investments such as real assets that can generate positive real yields at a lower volatility are extremely valuable. Higher yielding private credit investments with floating rate instruments, such as those within our Special Opportunities Fund, are also well positioned to protect against rising interest rates. And hedge funds and private equity can provide good public market diversification and alpha.